Welcome back, folks. All right, so I apologize on my tardiness. I was supposed to do this on Friday, and I was supposed to do a review on Thursday as well. Truth be told, I lost a childhood friend, and I'm caught up in my feels a little bit. So it's a little hard for me to focus. So I'm going to make this one kind of brief. I was going to do it like a shotgun Saturday type thing and talk a little bit more. I just don't have it in me today. Okay, so all right, so this is the weekly summary, February 28th, 2025. Now, obviously, it's Saturday here. It's March 1st, 2025. But we're going to take a look at the details as to what led me to the analysis I gave real time in the Telegram channel. It's really important before I continue that you go back and look at the content that I shared over the last couple of weeks. We talked a lot about how NQ, NASDAQ futures, was in a very large holding pattern on the daily chart. I'll revisit those points in this briefly, but I want you to go back and look at the posts I made in the Telegram channel. I want you to also take a look at the guidance that I gave in the YouTube video commentaries, the very specific price levels, the things that I was expecting to see, what I wanted to see, and then look at where we're at right now. Okay. So with that, let's take a closer look at the daily chart for NASDAQ. Now, if you've been following me for a while, especially this year, you know that there was two levels I was referring to on the daily chart for NASDAQ. Those being the relative equal highs here, which would naturally have buy side resting above it, and then this low down here. Now, these independent lows here, I also mentioned them individually. So they were targets as we were cascading lower. Each one of these were significant levels to aim for, but my focus was, and I took your attention to this one here, and then trade down into this inefficiency. Don't take my word for what I just said there. A lot of you that are new, it's usually a characteristic for someone that's impatient, that is overzealous. They want to get to the meat of what it is I try to teach. And there's a lot of things that you gloss over, and they're important things that have a great deal of impact in your understanding, and your learning curve is shortened. If you pay attention to the details, if you're watching the videos and the lectures and you're not taking notes, if you're not writing down the very things I'm referring to, you're going to miss a lot of salient points that are going to be helpful and beneficial to you as a student. But I stated that until we got outside of these highs or below these lows, the market was going to be held in a holding pattern, if you will. So it makes it difficult. But when the market does, in fact, go after one of these first, be it buy side or sell side, then the market would loosen up and you'd start to see a lot more volatility. This gap in here, I used two of my PD arrays characteristics and blended them together, that being the volume imbalance and the actual gap. Okay, so we watched this in here, and I had a interest in seeing it go higher. Don't take my word for that. Go back and look at everything I'm saying. Now, what I'm talking about is the bias on the daily chart, meaning that we would go up first to take the buy side out here, then the sell side. As you can see, the market does in fact trade after using this gap or volume imbalance hybrid, if you will. It uses it as support here and sends it above to clear the buy side above these relative equal highs. And then the remaining portion of this area here is completely rebalanced because we traded up into it here, marking over top of this single down close candle from that candlestick's low. You can see we repriced back to it. We spent some time back and forth and then left it. That means that all of this now is a balanced price range after taking liquidity. What's kind of liquidity? Buy side. So now, because it took this side first, it's reasonable to expect it to start working towards the lows here, 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 finally here, and down into this inefficiency. Okay. So again, Don't just listen to this and say, well, yeah, he said it and there it is. Go back and look at what I said. Go back and look at how I was calling the macro perspective, which is the weekly and daily. Now, while we didn't look at a weekly chart, the daily is a macro perspective. That means it's a bigger time frame. It's a whole lot more weight attributed to very specific PD arrays, and I'll go over them in this lecture here as well. So we use this gap volume imbalance pseudo PD array, blending both the characteristics, and it was something I simply wanted to do that. Sometimes I'll do it if I have something like this, where this candlestick doesn't have a wick to touch this previous candlestick's wick, and obviously the bodies are not touching. Okay, there's an absence of the wick that would touch here, would make it a clear-cut ICT volume imbalance. But because it's not doing that, I'm viewing it with that in mind, where it's a blend or a pseudo. So in this gap area here, okay, once we traded down below it, we can grade that, meaning that we're going to put a Fibonacci over top of it, draw from the candlestick's close down to the open of the previous candlestick. Okay, so we're using gap theory there. And all of these levels here, you can see how we went down below the gap on this candlestick, and then we opened here on Monday of the week we just closed in trading. So Monday we opened up here, we traded up into the lower quadrant of this inefficiency. So trading here, it doesn't even find its ability to get up into the consequent encroachment of that gap being 21,839.50. You can see that here. See how it failed to go up to that? As I taught in 2024's mentorship on the YouTube channel, when my PD arrays fail, that shows a significance in directional bias. When a PD array fails to get to its consequent encroachment, if it's a gap, or if it fails to get to its mean threshold, an order block. If it fails to do that, whatever direction it's moving in, it's signaling, if you will, an excessiveness in terms of bullishness or bearishness. So since we've taken the buy side here first, and we start to trade lower, our focus is on these lows here, 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 and down as much as this inefficiency here. And again, for the folks that are not students, for the folks that just casually watch, or if it's the first time you're watching it, when you see a video like this and you look at the date, you look at your charts and you say, well, this guy's explaining something after the fact. It's hindsight. Anybody can do that, which is why I started the video off with go back and look at the Telegram channel. I call that stuff live. It's time, date stamped. You can see it. I never delete anything. Okay. There's nothing ever, ever, ever deleted or edited ever in my Telegram or on my Twitter/X account. I have never deleted anything. So what I say either works or it doesn't. Okay. So on Monday, we open trade up into the lower quadrant of that gap and then breaks lower and attacks that low here. The next day on Tuesday, we open small little rally higher and then we drop lower again. Next day we open, we have a mixed day. So this is an inside day. Whenever there's a bias that's strong, one-sided, in other words, if it's bullish, or in this case, we'll use it here, when we're bearish and we're looking for these lows and this low to be drawn to, when the market breaks down like that and then creates a small inside day where the day's high is lower than the previous day's high and its low is higher than the previous day's low. That's why we call it an inside day, because this candlestick's range is inside the previous day's maximum daily range. So in other words, the day that doesn't break previous day's high and or previous day's low is an inside day. They are like a spring being twisted and compressed even tighter. And eventually, when it's let go, you have a lot of energy that's released. And it goes usually in the direction of the bias, which is the draw on liquidity, these lows, that low, and this inefficiency, as I guided this from the daily chart over the last couple of weeks. So the very next day, on Thursday, we open, we trade higher. And I'll explain why. Because a lot of my students, some of you are YouTubers, wanted me to go over why this was troubling for finding shorts. The open trading up into the high that fails to make even a tap back into the previous day's high. It drops aggressively, the largest range of the week, and then trades through our target here. And the very next day on Friday, we open, trade down, trade into the inefficiency here, and then look at this monstrous return back up into the range on Thursday. See that? So I want to kind of bring to light a little bit more detail. A lot of you know that I've taught and mentioned many times that, you know, that's my little handy dandy notepad, okay? And I'm always asked many times, what information do I keep on my notepad, and what am I keeping track of? What am I writing down? It's basically very specific price levels, like this gap down in here. This gap, I have annotated the high of it and the low of it, and then the consequent encroachment of it. So I want to have those levels noted inside of my notes, where I don't want to have my charts cluttered up with it. As you'll see, there's a whole lot of stuff I'm going to add here. And if I have it on my chart, it's very distracting. The way I teach, because you're learning how to use this information in the language I created for reading price action algorithmically, it's beneficial for you to have your charts dressed this way, because you won't be able to respect or build an affinity for their importance without having them noted in advance. So that way you can watch them real time, study them real time without taking a trade, without even trying to demo trade it. It's very important that you do that type of thing, especially when backtesting. So when you're backtesting and you're capturing things for like journaling, which is all of what I'm showing you here, this is basically, I hand draw anything that I journal. So I don't have the charts like this. I don't need it because I'm old school. I'm kind of like stuck in my ways. If I could go back in time, 33 years, before we were talking today, and I had the tools that's at your disposal today as a trader, as a technician, as a student, I clearly would be doing it as I'm showing you here. But I don't have my charts dressed like this, and I don't collect them. I don't do those types of things. I just simply hand draw in my journal, the very things I'm showing you here, because I can see it because I'm usually watching a handful of markets. So if I'm drawing it out, I know what I'm referring to. And if I have to go back through charts historically, it's easy for me to find them. Okay, so all of these levels in here, in this grading of that gap, that was there, that low, that low, that low, that low, that low, and this gap in the individual 3 levels. So it's not a zone. I'm not trading supply and demand zones. The high of that, which is the candlestick's low, and the low of the gap, which is this candlestick's high, and then consequent encroachment, which would be just simply the midpoint. Okay. So those are the levels that I had written down on my notepad. Every single day, I'm looking for new information that's derived from this daily time frame. So as the weekly range starts here, I'm watching all of this price action in here. All of this is back and forth price action. So this is all like a holding pattern. So from this buy side liquidity and this low, the market's being held. Okay, so the information isn't going to be as pure as it would be in a market that's a lot more fluid, meaning that think of this as chaff, okay, or confusion, or a smoke screen. So if you had the ability or technology on this day here to look through all this, like with an X-ray perspective, if you will, what would you see beyond the veil of this candlestick here? This. Notice this immediate rebalance occurs inside of the close proximity of this gap here. We open on Wednesday. Here, we trade up. We touch the previous Monday low. So when it does that, that's an immediate rebalance. We'll see that on the lower time frame. I'm watching these things occur as they form, but I'm monitoring this level here because it's outside of this, it's to the left of all of this back and forth holding pattern. Okay, so what this all represents is time distortion. If we were to take all the candlesticks from this candlestick here, all these candlesticks all together up to here, and just comprise all that data into just say 3 candles. And then from this candlestick here to this candlestick here, and we took all that range there and comprised it inside of 3 candles alone, this would look extremely fluid. But it wasn't like that, was it? It was very, very troublesome working inside these ranges. There's a lot of give and take back and forth, and a lot of basically consolidation, choppiness, and then 1 or 2 moves that occurred, and that was it. And if you weren't part of them, you weren't really participating in the moves. So what I'm doing is I'm looking through all of this to the left of it, and my attention is right there. This gap is energetic away from the retracement went down here, this low that created the sell side liquidity pool that we were aiming for. This run here, this is like a breakaway gap. It never came back down in until later over here, but that was after it made the high on the daily chart. So that's all-time high. So this gap is very, very important to me because of those very things. And if you missed it, rewind it and listen to me again. So I have a lot of focus in this general proximity when we're dropping down. I am anticipating PD arrays to form because it's going to be using this old range. So now we have the volume imbalance here at the low of the gap, and then this candlestick's low, which is the high of the gap. Extending it through all of the time distortion of these candlesticks back and forth, back and forth. I'm not paying attention to any of that. I'm looking back where the algorithm made it very clear, left a very clear calling card that this is what it's going to refer to once the market rotates and goes lower. So the market goes lower here, and then we have 2 candlesticks in here where we can look for shorts inside of this gap. Now, when it formed, notice it was a buy side imbalance, sell side inefficiency, meaning that it's a fair value gap with a volume imbalance, but it was an up close candle. So that's a buy side imbalance, sell side inefficiency, BISI, BISI. When the market's delivering sell side, reaching for sell side liquidity, we're going to be looking for a overlapping of that same range, but with down candles. And we get it here. So now we're inside the candlestick open here. We trade up to the high of that gap. Isn't that beautiful? See how that works? And it's also my immediate rebalance. The next candlestick on Thursday, we open, we trade up. We don't touch the high on the previous day. We can't get to the high of the inefficiency over here. And then we roll over. And we start working towards running out the low, the low, the low, the low here on the 19th of November. And then we had the inefficiency I aimed for and gave you guidance before it happened. So all of these levels here are also on my notepad. Now, why don't I share these things? Why don't I give them to you? Because they're personal. I promise you, there's nothing secret about it. There's nothing secret to it. It's just these are levels that I'm watching, and I'm using time of day. I'm using the opening range gap. I'm looking for new week and new day opening gaps to come in agreement with these same levels in terms of where I believe the market's being drawn to. So I already get a million questions sent to me by way of my comment section of my YouTube channel. So many questions sent to me on my X account on social media. And I get so many emails, I don't have any time to go through the plethora of emails I get all the time. Like I can't keep up with it. And if I was to provide you with all the levels that I'm looking at actively each week, the ones that are salient, I share with you on the Telegram channel. Those are the ones I'm watching that are pertinent to what I think is useful for that day. And for the most part, you'll see that they're being utilized. If I provide you more reasons to ask me more questions, all that's going to do is create even more disenchantment for the folks that feel entitled that I asked you something and I demand an answer. And my response to those that might think that or feel that way, I haven't responded to you or given you a direct answer. It's because I know if you spend time with me and none of this is costing you any money, okay? And I promise you, no one else called these moves like I did. And it's not bragging. I'm just being honest. No one else outlined it like this. This is literally 1,000+ handles, 2,000 almost. So, I mean, think about it. Up and then down, And these are not small little moves. They're rather large. So I'm not obligated to give you everything at your whim and request, but I do feel confident, like I've always taught in the past. If you hang out with me and you take good notes, 99% of the questions you have that arise up in your mind while watching me, they will be answered. Either because I'm going to revisit ideas that you probably didn't take notes on in the 2024 content, or you just simply aren't paying attention in the times I'm talking about it. Because sometimes I have videos that go a little bit past the 5-minute threshold. I'm confident that if you give it time and you hang out and you watch, okay, if you were paying for this, you'd be more interested, I think. But because it's free, you're just thinking, well, I'll wait until he gets my attention with something. And if I haven't got your attention thus far, I'm probably not somebody that you need to be looking at. Go look at somebody else. Because what we're doing here is the aspect of actually following what was actually taught on the YouTube channel. I'm not lecturing and teaching something new. I'm just showing you me using what I've already taught on the YouTube channel. So if you give yourself the patience or develop the patience to show up every day and take good notes, I promise you, majority of the things you're looking for in terms of getting an answer or a response, a shortcut right to what you think gives you a better understanding. I'm not a mentor like that. I believe that you're going to learn by hands-on. You're going to learn because your hands are involved in it. You're going to be handling the price action each day. You're going to be watching what I'm looking at. And over time, you're going to see these things tend to repeat. And you're like, oh, wow, I see how that's happening. But this is the part that you don't see. Okay. I've never shared this even when I was doing paid mentorship. I never gave them what was on my notepad. And it's not me holding something back that makes it easier for them. It's just these are the things that they should have already looked for because of what I taught. So, because there's a lot of people out there that copy me, they take what I say and repeat it. That's also the number one reason why I give guidance on setups on 1-minute charts, because the time that it takes for the person that was in there trying to copy or parrot me, they have to see that, and then they have to figure out what I'm showing in that chart. And by the time they figure it out, the market's already moving, and they can't communicate that effectively to the people that they're trying to do signals for. So that's the rhyme and reason why I'm doing it. I can certainly do setups on a 60-minute chart. I could do it on a 4-hour chart. I can do it on just a daily chart. But I do it because I get abused a lot from other people that simply ride my coattails, and they want that. And that's why they've always wanted me to do live sessions where I'm trading, because you see how I trade. You see it. Okay. It's undeniable now. Okay. But it irks me. It gets under my skin when I see people that have no talent, no class, no couth, and they'll pretend in their own country, where the people that they're talking to and pretending that they figured this out themselves, they have no idea who I am. And that's not me trying to be more of a celebrity or something like that. It's just, it gets under my skin. So to eliminate that taking up space in my thinking and my concern while the markets are moving, I do what makes me comfortable. And again, that might not mean that I'm the right mentor for you. That's why some of my students who have learned properly, there's a few of them out there. They don't know everything, but there's a few of them that actually have made models based on the things I taught, and they teach other people doing what they have done. I have no problem with that because they give me credit. They know that they learned it from me, and they can see that I'm not trying to stand in front of them. Okay, the folks I don't like are the ones that try to take my videos and put them in their own native language and then try to get ad revenue or sell them as courses. You didn't deserve that. You didn't do the work for it. Or the ones that pretend that they found it themselves, or they use my language and my vocabulary and concepts, and they claim it's Wyckoff, or they claim it's Elliott Wave, or they claim it's something else. Those are the people those individuals is what I take odds with. So it's just, I'm not losing any sleep over, mind you, but I'm answering a lot of questions right now. They may not be the questions that you have asked for, but I get a lot of questions, and I'm responding to them in a blanket response here. So, as I said, the things that I'm watching outside of the daily ranges that we're watching form intraday are found from the daily chart. Okay, so I'm watching how these price fluctuations move and they gravitate and gyrate in between where I think it starts the move and where I believe it's going, or the terminus, or the draw on liquidity. And as new days develop new PB arrays on the daily chart, I'm constantly referring to those ideas and I'm adding them to my notepad. That's what you're hearing. Okay, this is simply just a little yellow notepad and an ink pen and me scribbling down levels from highest to lowest. And as new ones form, I'll add them. Okay. And that's it. That's all I'm doing. Now, that is not a secret weapon. It's just the way I've always remained organized. It is not the best way. Okay. The best way for you as a student learning from me is simply dress your chart like I'm showing you here. Okay. I'm just not accustomed to doing it this way, but I do it because there's no other way for me to communicate it to you. So because you're learning how to do it, you may get to the point where, you know what, I'm going to try to do it with this method of only having it written down in your notepad. I will say this, if you're used to seeing it on your chart, it may be a little problematic when you're constantly looking away from the chart and looking at notepad annotations. And because it's not the best way of doing it, and I'm making sure you understand I'm saying this, my methodology of having it on a notepad is not the best. It's not the optimal level of organization, but it works for me because I'm old school. Okay. This is the way I had to do it. Okay. I had to have this information next to me while I was driving a truck. Okay. So I had to have a job when I was younger, and this is the way I stayed informed. I would look at where price was in respect to this information. You have the advantage of having it on your chart, watching it and keeping it very organized and journaling it as it's being added to your chart. So when you're journaling or when you're back testing or you're looking through old data, collecting the information like this and keeping reference to it, and in all these little empty spaces over here as you do the screenshots, you should write down in your annotations what you feel is pertinent, what is salient to you, what is important observations that you've noted in price action, or what you're expecting. And those are the things that majority of students, not just in my fold, but in everyone else's, when they're learning how to trade, that's one aspect of development that is not used or utilized enough for the student. That means back testing and journaling. Because if you don't keep a record of your observations, you're going to forget it. If you don't celebrate the recognition of seeing something as it forms live, and you expecting it to do a certain thing or behave a certain way, and it does it, you need to celebrate those moments. Okay, you have to immortalize them, and the only way you can do that makes sense is to journal it. If you don't have a record of it, it didn't happen, or you'll forget about it easily. And that's unfortunate because there's lots of you, I'm sure, if you would have been more organized in the beginning, you'd probably be better off now as a trader. And you probably would have been better at getting to where you feel comfortable taking trades more consistently and not worrying about being wrong or losing if you would have been organized. And by having a great deal of record keeping with journaling and back testing moves that have already happened. When you buy a book, okay, when you buy a book about technical trading and trade setups, you're not watching that real time. But if you like that author, if you like that methodology that they're teaching or promoting, you look past that. Isn't it interesting? You look past the fact that it's all hindsight because you see value in the fact that you're going to look for what they believe is the most important points to put into a book. Well, I'm writing volumes, okay? I'm writing an encyclopedia of algorithmic price delivery. Every time I talk, I'm giving you chapters of books that you're not finding the information anywhere else. These things are never going to be retained by you unless you go through the information, journal it, and then draw out of those examples that you can go back in your own charts and see. When you immortalize them and have them in a journal, and then you get really good at keeping record of where certain things are. And I'm not even going to go into how that would be effectively done. I just think that that's, it's above my pay grade. Let's say it that way. But let's get back to the discussion here. We're going to drop down into an hourly chart here. So everything that was on the daily chart, okay, has been shown over the context of a 60-minute or 1 hour chart now. Okay. So here's that daily volume and balance gap that I graded. And then here is Sunday's opening by contrast and Friday's settlement price. So that's our new week opening gap. So we trade up in the lower quadrant of that daily volume and balance pseudo gap. It trades to the lower quadrant and then breaks aggressively, trades back through the new week opening gap. Notice that once it traded through it to the downside, it only found its way to finding a retest to the low of the new week opening gap or Friday's close. It didn't have any interest at all in trading into the consequent correction of the new week opening gap. And then it traded lower. Does that indicate bullishness or bearishness? Exceedingly bearish. Why? Because it's not even interested in revisiting the midpoint or consequent correction of the new week opening gap. Notice that? And the market falls off to take the low here and trades down into that old buy side and balance, sell side efficiency that we now have traded down below here, which makes this what? An inversion fair value gap. So we want to watch it, see it go up. It trades to the high of it, and that's the immediate rebalance on the daily chart. Okay. So when you're looking at these charts here, the information I'm showing you here, you want to create this in your own charts. Don't just simply take what I'm showing you here as notes and saying, okay, well, I'm just going to use his and save myself the time. You'll never learn doing that. I had paid students that simply just did what I did every day, break the market down. This is what I did. This is what I'm looking at. This is what I was using. This is what we were watching. And then whatever charts I created and any annotations I had on them, they used that. And they're the same individuals today that don't know how to trade. And they've been with me since 2016. Not all of them, but some of them. I've had students from 2016 email me and beg me for me to pass their combine or their, what do you call it, the funded account challenge. Could you just pass it for me and I'll trade it after that? No, that's lazy. So you want to take this information here and spend maybe Sunday before the market opens up and try to duplicate what you see here in your own charts. And then anything you see extra, you add to it that's important to you. Don't just take what I'm showing you here, because these are the things that were important to me. Over time, you're going to see there's a rhyme and reason of what I'm doing. But it's not something I could write down in a book or show you in one video. This is why I look at this and only this right now. It's what the market's doing. As we were talking about in the beginning on the daily chart, that time distortion, it presented that. There's going to be times where there isn't that much of a time distortion, where the market just was range bound and idly just back and forth trading. It's frustrating when you want to see sustained price runs because you see deeper retracations that you're not willing to hold on to. Where in other instances where it's not being held in consolidation, in time distortion, the market's easy to hold on to a price run because it's more fluid. Well, for the first part of, I guess, December into just recently, this past week, the market's been strangled and been held in a very large trading range. So there's things that I do based on what the market environment is showing at the time. And there's so many things that I have in my toolbox. I can only talk about them, and it's always beforehand. I'm always explaining to you why I believe the market's going to go to a specific level, because I'm showing you the levels I'm aiming for. But the logic that's outside and above that is many times rooted on higher time frame charts, at the very minimum daily. Okay, so the market breaks down below that old buy side and balance, sell side efficiency. On the left side, okay, just for clarity, this box here, okay, let me go back up to the daily chart because I want you to see it. That's this range here, okay? And we just extend it through all this mess, and we're looking at this price action right here. This little price action right there inside of this gap that I've highlighted in, I guess, orange or whatever that would be, that's this same area here. Okay. This drop down here on the 1 hour chart, this low right there, that's occurring on the daily chart right there on this candlestick. Okay. So that way we're able to keep track of what's going on. This is the price delivery continuum. Okay. So watching price, how it behaves algorithmically on one time frame to the next time frame that's lower. Okay. So with that in mind, the market trades back up, hits the high, and then gives you the immediate rebalance on the daily chart. So when it touches that line right there, this moment, at that very moment there, that's this daily high touching Monday's low. This is Tuesday's trading. Wednesday's high is touching Monday's low. That is an immediate rebalance because we have a sell side imbalance, sell side imbalance, buy side inefficiency here when we opened up, and then it completely rebalances in one session, the same session that would, if this candlestick would have had a lower high, the gap formed would be a traditional ICT fair value gap. But it doesn't allow the fair value gap to form because it goes immediately back up to the previous day's candle. So those three candles that would otherwise may create a fair value gap, it denied it and completely rebalanced it. As I taught you in 2024, and for the folks that were in my paid mentorship years ago, my immediate rebalance is one of the strongest algorithmic signals when you have a directional bias. It's either going to immediately start that candlestick when it comes up and touches it and gives immediate rebalance. In this case, we're bearish. It would have sold off aggressively on that candle, or what? The very next one. And my paid students can call me a liar right now on X if I did not teach that. I've taught it to you publicly in 2024 content as well. So I have it all over the place. You're not finding that in anything else. Okay. Wyckoff didn't talk about that. Supply and demand doesn't talk about it. Chris Laurie didn't teach that. Larry Williams didn't touch it. You know, I can go through the gambit of going through all these other people that people say I borrowed their logic. Next candle, if it doesn't drop precipitously, as soon as it creates the immediate rebalance, the very next candle is going to be like this, take off. And I'll ask you, does it look like it took off to the downside on the next candle after the immediate rebalance? I believe your daily chart looks like mine. Maybe not like this in the annotations, but it looks like that in terms of where it went. So we have the immediate rebalance here, and then watch what happens. Watch real closely. The market goes back up inside of that inversion fair value gap. So we come back and we touch the high of it. We dropped outside of it. Now it's validated. Okay. We want to see it respect the lower half and disregard the upper half. What does that look like here? Well, this is consequent encouragement, the 21,319 level. The market goes above that, yes. But does it come all the way back up to the high as it did here? No. It leaves a small little portion there. So the market shows the bodies staying below the upper quadrant at 21,358.25. Yes, the wicks go above it, but that's the part of the price action that's like it's like a gray area. It's not black and white finite. And that's what makes trading a little bit more difficult for people that are studious or academic. For instance, like my uncle, he was very, very studious and academic. He was book smart. I'm not book smart. I'm more street smart. So I can see things and say, okay, well, it's normal to color outside the lines. Because as a kid, I did that. Okay. So here, the bodies are telling you the story. It's saying that, okay, it's done enough. And it's not hitting the upper quadrant. And even with the wicks going above that 21,358.25 level, it's failing to go back to the high of that inversion fair value gap. That in itself is a signature. Okay. So the next candle, we open up, trade up again, fade it. Breaks aggressively, but below relative equal lows. And we get a little bit of a chopping back and forth in here. On your charts and on your notes, this candlestick right here, measure half of that right there, which is consequent encouragement. See the bodies respecting it there. Extend it forward into these candlesticks here, and you'll find something really neat, even on the 15-second chart. That's extra homework, no extra charge. the market breaks aggressively and trades into our first target of 20,640.25 right in here. And then the inefficiencies traded to on Friday, that lower fair value gap on the daily chart. That's this level here, and this blue shaded area is this on the daily chart. That's that low. See it? 20,640.25. And this gap here is that blue box it trades down into there. Well, that's occurring Thursday into Friday. And we have the retracement back up into this inefficiency right there. From the weekly perspective, okay, the entire time when the market's trading and moving in the direction I'm expecting it to do, which is the 20,640.25 level. And again, go back and listen and look at the things I've highlighted. Those are levels that were given in advance. They're not after the fact and say, well, look how pretty it is. As the market's dropping down, I'm considering what the weekly range looks like. And this is a crude depiction. I don't have I know some of my students have created indicators, and I'm not about to start messing with them because I'll start going through everybody's version of it and I'll waste my time doing it. Not to say that it's a waste of time having it, but my time right now is extremely limited. So I think about it like this. The market opened up here on Sunday. That's me drawing this line here. That's that price right there. That high is this high here. And as it's dropping down, in my mind, every day of the week, I'm envisioning how it's going to trade down to that low and into this inefficiency. So the low of the week is depicted here. But in my mind, I'm watching how it goes below this 20,640.25 as a draw on liquidity and the top of that. So in my notes on my notepad, I have this blue box is high. And then it just goes lower, obviously. And I just annotated it here. So that's how I put my notes in summary. For my journal, I write down that the weekly range extended through and just outside for like a mohawk with that candlestick's low right there. But in my mind and throughout the week, I'm watching just for the high of that to be traded to. Certainly this level here, but that's my goal, if you will. Okay, that's my moral victory. Whether I'm trading it or not, if it trades there, I feel good for myself, and I tell myself, well, that was done well. And I literally write that down and say, that analysis was done right or done well, or I feel good about what I did. It was really accurate this week, or I was accurate this week. And I give myself those little bullet points because subconsciously, my subconscious will retain that like a sponge. And even though there were problematic periods of this individual week, it kind of like smooths out those rough edges. You want to be very supportive and much like a cheerleader for yourself in your own journal. You don't want to pour it on so thick it's you're going to give yourself a diabetic coma, but you want to be realistic about your encouragement to yourself. All right, so this is a 15-minute time frame, and this is the minimum that I think you should have in your journal. So if you've been watching what price has been doing and you're using these time frames, the very minimum, this is what you should have on your charts. Okay, and I'll talk about other parts of the chart that were, in my opinion, salient, but you can include them on yours. Here is that daily gap volume imbalance, as I mentioned before, touching the lower quadrant of it. And here, and finally breaking away, trading over top of the new week opening gap, and then trading right up to the new week opening gap low. Okay, and then it drops from there, and then it creates this smooth level in here. And even there, it just got to a point where I expected fully that it would likely try to upset this. And to be honest with you, I was surprised to see it left intact. So I think that might be something that may get revisited, in the next weeks or whatever, barring any kind of major continuation on the sell-off, right? But this is a really, really logical level for liquidity that's being built up for anyone that's short. And to my thinking, okay, and think about it. Say this was to trade down below 19,000 on NASDAQ, okay? Let's just say over the next couple months, especially going into like May, let's assume that we're in for a deeper sell-off. In my mind, if I was making the market for NASDAQ, I would want to come up here and clear this out. Now, I'm not saying just go up there by a couple handles, but maybe just like run it up in here, maybe up into this inefficiency entirely. And then whatever rollover after that might be, really exciting. It's just something I have in my notes, okay? So I'm not trying to push it as a hard sell that it's going to go up here to these highs. I'm just saying that it's just really uncharacteristic for the market to leave something that smooth and straight line, especially if there's going to be a precipitous drop later in the year. You know what I mean? So anyway, the market trades below that former buy side and balance, sell side efficiency. That when we traded below it here, it changes its characteristic to that of a inversion fair value gap. So since it formed in the basis of a buy side and balance, sell side efficiency, when it changes its characteristic to what? Now bearish. So what was usually bullish now is going to be used as a bearish PD array. And this line is that line that I showed you is the immediate rebalance. But you want to do your annotations on the daily chart and let them be seen or visible on the lower time frames. Okay, it's really important you're able to do that. This inefficiency here is the first one after the market rolls over at the beginning of the week. So I want to grade that always. And as you can see here, we're using the volume imbalance of this candlestick's close, and this candlestick's high is the low of the SIBI. Okay, we're not using this candlestick's low to this candlestick's high. There's a slight difference between these two price points. This candlestick's close is slightly higher than that of this candlestick's opening price. So that is a volume imbalance. So you want to make sure you're using that there. And notice what's occurring in here. These are the very things that I taught my private mentorship students, okay? And because it requires work, it requires more than just a glance, a passing, peek at it on a chart. Because it takes time to make your charts, annotate them, screenshot them, journal them. If you don't like that part of trading, I promise you, you will very much struggle with the adversities that come by way of just a natural progression in learning how to be consistently profitable. And that's why most people can't find consistently profitable, because they don't have the due diligence. They don't have the wherewithal. They don't have the commitment. They don't have the tenacity to stick to something, even though it's uncomfortable, even though it doesn't put money in your pocket right away. And that is backtesting and journaling. I promise you, if you know someone that's just recently found themselves in terms of profitability, one of two things are going to happen. They're going to, if they're honest, they're going to reflect and say, you know what, I probably would have been better off if I would have been much more organized and I did these types of things. I would have been able to pick up on my problems and my errors and then repeating occurrences where I'm holding myself back. Or their temporary success falls apart because they didn't do this part. Okay, so it's real important that you take away from this is that being organized, journaling, and getting the information out of old moves, that's your best teacher. Not ICT, not the guy or gal that you're paying as a mentor. The back testing and hindsight, those are your best teachers. And when you remove the stigmatism that's placed on hindsight, I mean, if you're trying to promote a signal service and you're only showing what you did right, then obviously there's a problem here. But if someone has a signal service and are able to say, here's what I'm seeing right now, this is what I believe market's going to happen to go here or go there, and I believe a stop loss at this price level, and you're able to see that for a month or two consistently, then I think that person's earned a measure of attention that's afforded them. Otherwise, hindsight is not beneficial there. But any form of education, all forms of education, has a considerable amount of hindsight. And when you go through your charts, like I'm showing you here, you're building up your understanding at your own pace, and no one can look at your charts unless you share them publicly, which you shouldn't do. You never feel like you got to keep up with everybody else. And no one's going to criticize your charts because they're private, they're yours. And that's an incredibly important facet to developing properly. But this inefficiency here, I grade that, okay? So the very first inefficiency that forms once the week starts, really important. It's along the same premise as the first percent of fair value gap. like a new week opening gap. You extend them throughout the entirety of the week, and they're going to be utilized again. But in this case here, because we have a directional bias, it's bearish. The high of it to the low of it, and then the consequent encroachment. Look at the consequent encroachment midpoint. See how the bodies are respecting that? Yes, there's little inert wicks above it, but that's permitted. That's just like coloring outside the lines. This is indicating that we're not likely to go higher. So if we're not likely to go higher and we can't even close in this little portion here to that candlestick's high and that candlestick's low, that makes this a candidate for a breakaway gap. It's also occurring right at the low of the new week opening gap. See how these things blend together? So when you're doing your annotations, you have to really spend some time. Put some calming music on or some driving music, that you really like, that makes you feel good, that it has your attention up. You should not be listening to some crazy, wacky rave music when you're trading, because you don't want to be elevated. Your focus needs to be 100% dialed in and no additional stimuli. It should be calming, very, very simple calming. But studying and backtesting, that's where you want to have the high energy. You want to feel like you're in that movie and you're the main character, and they had that awesome soundtrack playing. Like, for instance, Moby's song from Heat. When that movie came out, that was like my go-to song. When Al Pacino's racing, the chase, after Al Pacino, and it's this instrumental song. It's awesome track, and that was my joint. Like, that was my jam when I would back test and look at old data and stuff. Wonderful way of just staying energetic. It might be a little too old school for some of you. I think it's a timeless track. It sounds awesome. But whatever you like listening to, when you're back testing, make it fun. Make it like almost like a form of meditation. Some of you guys and gals that go to the gym, you work out, you've had to condition yourself to do that. You have to tell yourself, this is what I'm going to do. This is part of who I am. As a trader, this is what you have to do. If you really want to be organized, if you really want to have the visibility to see setups that the average person in trading isn't going to see, you do these things. Notice that I've shown basically 3 perspectives just on this one 15-minute time frame. And it changed just in this area here. 3 different screenshots. But look at the level of clarity and depth of view of seeing what price is doing when you do these types of things. I'm going to say it again, and it sounds like a cop-out answer, okay? But it's the truth. When you guys ask me collectively, in all forms of medium, why am I looking at that gap? Why am I not looking at this? And why am I not looking at it's because I'm showing you what I've done over the years that trains my focus into looking at these types of gaps. When there's not just one level of information being presented to you with that one gap, there has to be other things in agreement. It's like a confluence of things. So just simply because there's a 3-candle formation and there's a down closed candle in the middle of the 3 candles, that doesn't mean it's an inefficiency that I'm concerned about. It has to have something along the lines of time. Well, what's the time aspect here? It's the very first displacement after the start of the week in the direction of my draw on liquidity, which is a lot lower on the daily chart. Because it's the first one, I want to see, does it perform and show signatures of breakaway? Breakaway means it's like rocket fuel. It's going to really set my directional bias on fire in terms of the magnitude, the speed, the veracity into how fast it wants to go there. Those are the types of trades I'm teaching students to learn to look for, not just the average 1-to-1 type thing. They're easy bread and butter stuff. I've taught you that. It's all over the YouTube channel. But to be exceptional, to be a cut above everyone else in finding setups that absolutely destroy and lay shame on everything else out there, you have to look for things like this. And over time, it makes your technical analysis technical science. It makes your ability to see these setups crystal clear, laser guided, Okay. It's like having, well, I can go on and on. It's going to sound like bragging, and sometimes it hurts everybody's feelings that aren't really here to learn. But when we had this delivery here below that old buy side and balance sell side efficiency, it acts as a inversion fair value gap. Scrubbing over to the right a little bit, that's that move we just talked about here, and it climbs up. Look how it uses the low of that old buy side and balance sell side efficiency, but we're expecting it to perform as a inversion fair value gap. Look how it uses the grading or the quadrant levels that's been added to it. Low, lower quadrant, body's just outside of it a little bit, and then rallies up, lower quadrant, consequent encroachment, high, immediate rebalance on the daily chart. Monday's low, it touches. Okay. So Wednesday trades up to Monday's low, immediate rebalance on the daily. Notice I added the annotation there. You have to be diligent about keeping record of what levels you have when you're doing your back testing and journaling. When you take your screenshots, you have to add the information that helps you keep track of what you're looking at on the lower time frames. Just putting a line on it from a daily chart or weekly chart, you're going to lose the location and the importance of what it is. What is it talking about? What is it showing? What's the story behind that level? If you don't add the annotations to the levels or the PD arrays, you're going to get lost in the sauce. So the market drops from here outside of it once more. So that validates this now as an inversion fair value gap. So we're going to watch this midpoint to the high. We want to see it disregard this upper portion. The market trades up, creates the low on that candlestick right at the low of the inversion fair value gap, trades down here, gyrates around the consequent encroachment, shoots up in the upper quadrant, fails to touch the upper half. And anything rolling over from there is ideal. What is this low and this low? You can't recognize it easily when it's zoomed in like this because you're too close to the trees to see the forest. These would be relative equal lows on the daily chart. But right here, watch what we're doing. We're going to scrub over, and that's here. Market breaks down, trades precipitously lower, and then we have this gap here. Why am I not using this one here? Because it left that inversion fair value gap. I naturally want to see that always act as a breakaway gap. Okay, that's for the people that are paying attention. No extra charge. But the next one after that, we've taken this low out and we traded into liquidity. Now we're going to have to use this information here. So this candlestick's low, this candlestick's high. Grade that. Look at the body stopping, rate of consequent encroachment. The wicks are allowed to do damage, but notice they're not going higher each time, they're going lower. And in lower quadrant here, the breaks aggressively lower and then trades into our 20,640.25 level, and then into the buy side and balance sell side efficiency that I gave you as the low end target on the daily chart for NASDAQ. And then on Friday, we see it trade down just outside of it a little bit, rallies higher, drops down once more, and then pumps up into the old target or initial target I gave you at the 20,000, I think it was 943 or something. Here we have the range here shown on a 1 minute chart. It drops down here, works inside that inefficiency using the quadrant levels, and breaks down and trades lower. On Thursday, this is the part of the review that I told you I'd give you. Here's Thursday's opening range gap, and you can see it with the regular trading hours. So here's the opening price at 9:30 and regular trading hours settlement price, which when we have an opening price that's higher at 9:30 Eastern time, if it's higher than regular trading hours previous settlement, that means you're going to have a premium gap opening. And that's the regular trading hours settlement price will become the opening range gap low, and reverse that when you have a 9:30 opening price that's below regular trading hours settlement price. That means you'd have a discount gap or a lower gap opening. And that means it would be the opening range gap high. So this level always has two names. Initially, it's the regular trading hours previous settlement price until we get to 9:30. And then depending upon where that 9:30 opening is in proximity to this level, which is the regular trading hours settlement price, it's either a gap higher or a gap lower. And then you change the name of this level to opening range gap high or low based on the proximity of the opening price at 9:30. And it sounds much more complicated than what it just sounded like. It's easy. It's really, really easy. It's either we open higher at 9:30, where we settled at the previous day using regular trading hours, or we open lower. Okay, and then label it based on that. So we open up inside the inversion fair value gap. Okay, we fail to get to the upper half. We break lower aggressively, and notice it doesn't even do a return back to the first presented fair value gap. It doesn't even come back up and touch consequent encroachment. It just falls out of bed aggressively, and it doesn't even come back and touch the low of the inversion fair value gap. It just gives you the opening range gap low, which is what I gave guidance on. Once I saw that it was not giving me anything to basically get short on, I wanted to see if it was going to try to pump outside of the inversion fair value gap, because I was concerned that we were going to get a little bit of static in there first and then come down and do the 70% likelihood of the mid gap being filled, which was here. Okay, this white line level. This level here is mid gap or consequent encroachment from the difference between this candlestick's opening price, this candlestick's closing price. I'm sorry, this candlestick's opening price, this candlestick's closing price. I'm not sure if I said that right. Upper quadrant, consequent encroachment of the opening range gap. The opening range gap is between these two darker lines here. 70% of the time, the market will retrace back to half that gap. Well, it does that and then just keeps on falling outside of the daily inversion fair value gap. So my attention went to, okay, well, we're not showing any importance placed on any of the levels I have inside that inversion fair value gap. It's exceedingly what? Weak. So if it's weak and my bias is bearish, we're going to get down here real quick. So the only thing I could do is what I gave guidance. I said the opening range gap low is providing or lending resistance here. And that was pretty much all you get. You have a small little institutional order flow entry drill here. Then you have an inversion fair value gap here. I'm not adding all that because when we broke down here, this is a bearish fair value gap. Trade up into that, and that was all she wrote. Breaks aggressively lower. And as we traded down into it, ticker tape parade. Yay, randomness again. And then I was done for the day with Telegram. Then the market retraced back up into and consolidated and then created an afternoon session run. As I taught recently and in 2024 content, paid mentorship students learn this also in the day trading modules. You can find all this stuff in the lectures on my YouTube channel. So at 1:30 p.m. Eastern time to 2 o'clock, that's your opening range for the afternoon session. Same thing we do at 9:30 to 10 o'clock in the morning for the opening range in the morning session at the opening bell at 9:30. Well, your afternoon session, you want to use this 30-minute period, okay? I don't care. All these people out here talking about 15-minute ranges and stuff. It's always 30 minutes. Okay. I promise you, the algorithm is using 30 minutes of initial range. It's 9:30 to 10 o'clock. And then at afternoon, it's 1:30 to 2 o'clock. Do not take my word for it. Start charting this way, and you'll see exactly what I'm saying. It's there every single day. So, small little gap in here, but the largest, most prominent one is here. So, market trades up into that. The body stays inside of it, respects it, and then breaks away during the 150 to 210 macro, as you would expect, in the direction we're looking for. It trades down lower. It trades below the 20,943 level, which is February 3rd sell side liquidity pool daily chart. Look at that. These are the levels I gave you in advance before it happened. The market trades down, consolidates in here into the 250 to 310 macro using this sell side and bounce buy side efficiency. It fails to do what? Work inside the upper half. That's exactly what you want to see it do. The algorithm is flagging and saying, hey, hello, I'm about to go lower quickly. And then the market drops out during the 250 to 310 macro. One more fair value gap in here, and it dives down in. And then you have market on close, which is the 350 to 4 o'clock. That last little flurry of activity where the markets are being driven algorithmically. And the market dries down one more time below the November 19th, 2024 low for the sell side, dives down, falls just short of that old inefficiency that I told you it would be a target on the downside on the daily chart. Okay, and on Friday, I was not able to spend time with you all. I was, like I said, in my feels and doing things in my personal time. Opening range gap and first presented fair value gap in white. So the market trades down into it there, rallies up, one more time digs down into it, and then we have this little gap here. I wasn't watching at the time, otherwise I would have bought it there. But inside here, once we traded down into that, I went long and aimed for just a simple little buy side liquidity pool. They got out on this run here, and it retraced all the way back down and went lower than the first presented fair value gap, but didn't take out the low. So it's the lower quadrant of that blue shaded area on the daily chart. So remember, what this blue shaded area is the very first chart I showed at this recording. Go and add your gradients on that level based on the daily chart, and you'll see where it's trading down to here. Then it rallies back up above the opening range gap, down into first presented fair value gap once more for the afternoon session, and then rallies up and trades back to February 3rd's old daily low at 20,943. So it's a really nice run, but I'll show you some executions here. Here is the, and I can't obviously show you that the markets are open at the time when I made the recording here. This is market close. If you do market replay, you won't be able to see this. So that's why it looks like this. That's why I'm doing that. Okay. For the guys that keep asking, why am I always showing this? It's a constant reminder that when I'm executing and when I'm calling this stuff live in Telegram, any execution you see me doing is not on market replay. It's live market executions. Okay. So I went long into this gap here, and then these relative equal highs. There's buy side there, and there you go. So I'm highlighting there so you can see the actual little caret entry right there at the top of that gap. That was my entry. And then the price level, you can see at 20,685.25. That is right in this proximity, which is right above here is what I was aiming for. And that's what that exit is. So it was a quick little, grocery getter type setup, simple, easy. And then after it takes my target that I gave you on the daily chart, then I can start working towards doing reversal patterns with a greater degree of confidence. That's it for this one, folks. I hope you found it insightful. I appreciate your patience and not getting on me about not delivering on the Thursday and the Friday. So until I talk to you on Monday, Lord willing, enjoy your weekend and be safe.